Hello fellow investors. Today we're going to take a close look at a company I don't think need any further introduction. Coca-Cola company, stock ticker KO, currently trading at $52.38. Year to date down around 17% and over the last year down roughly 7%. Yesterday they took quite a beating, down almost 5%, basically because investors are thinking they're going into a very weak earnings season, also along PepsiCo. So in this video, I want to take a close look at the intrinsic value of Coca-Cola to see whether or not this dip is a perfect buying opportunity. Over the last year, they have not outperformed the S&P 500, actually down 7% as mentioned earlier, while the S&P 500 is up around 12.5%. They do, however, offer a quite nice dividend yield around 3.5%, annual payout of $1.84, payout ratio of 70%, quite high, but I think it's transitory right now. 5-year growth rate isn't that high at 3.4%, but a dividend growth streak of 60 years. Very nice, and a very few companies that can match this. And as you can see here, basically dividend history up and to the right, steady growth just as we want to see it. If you take a close look at their financials, they are also growing their revenue, which means there's basis to actually grow the dividend in the future. Coming down here to see the net income, also growing from 6.4 up around 9.5, 10.5 in the last report. If we look into the cash flow statement, then we can use the net income, go down here to see the cash flow operations. Using the capital expenditure to subtract that, we actually get the free cash flow. You can see here they have quite steady capital expenditures while they grow their cash from operations, meaning they are making a higher amount of free cash flow year on year. In the bottom of the cash flow statement, we also find the free cash flow per share sits at 2.19, 2.20. And if you remember what the actual payout ratio was, you can see here that is 1.84. So there is some room to grow the dividend, but not a lot coming into the next couple of earnings reports. So definitely be wary about this. But again, I think Coca-Cola will definitely survive this, obviously, because they are indeed a major company. Before we jump into the intrinsic value calculation, I do want to check what the Wall Street analysts are thinking, and they actually have it rated as a buy. You can see here on the right, analyst breakdown, 24 analysts. Half of them has it as a strong buy, 6 has it as a buy, and 6 has it as a hold. No on the sell side, basically. And if you come down here to the price target, you can actually see it's quite hefty, around 32% upside from the current levels, with an average price target of around $70. And if you jump into a stock screener, you can see here, if we zoom in a little bit more, so you can see everything a little bit better, we do have some of the key metrics on the left here. You can see that the PE ratio is definitely below the 5-year average, so could be a potentially good buying opportunity at the current level. I think the revenue CAGR is a little bit on the low side, but again, it's been around for many years, so it is a very dependable company, and sometimes steady growth is just what you are looking for. Net debt to EBITDA ratio sits below 3, very nice. Return on invested capital and return on equity are also at extremely good levels. Analyst target price around 70 as mentioned earlier. Very low short interest, also very nice to see obviously. And looking at some of the margins, you can see here the operating margin is actually on the negative side right now. Operating margin for the 5-year average is 26%, but they haven't been able to grow it over the last 5 years. Maybe they are experiencing pressure from the economical environment in general or globally, or they are being pushed by some of their competitors. That is something you would definitely need to look into. Profit margin sits at around 24%, which is extremely high, and also gross margin at 80%. So some of these numbers are looking really good. And as mentioned, the dividend stats we have taken a closer look at earlier. Jumping into our dividend data tab just to take a closer look, what we want to see here is basically some steady growth. And you can see here they sit nicely around 5, 6, 2, 4, 5, and the 10-year growth rate sits around 5%. So the last couple of years has been a little bit lower, but I think in the long term they will definitely keep this trend up of around 4 to 5% growth each year. In the same tab, we can come down here to the dividend yield theory graphs, where you can see it actually sits at at least according to the dividend yield theory, quite nice discount at the current levels, around 12% right now. And you can see on the right, whenever we move up into the blue area over here, it actually could indicate that it is undervalued at the current levels. Definitely looking really good so far. We do, however, also have a lot of different valuation models. The discounted cash flow, I don't want to go into the details of every single one, so I'll just go through them, and you can pause the video here at any point if you would like to look into some of the details of the different ones. And as you can see here, the last one is the Peter Lynch model. Before we jump into the summary, thank you so much for watching, and if you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary for Coca-Cola. As you can see here, we do have all our valuation models here on the left, and I think we can basically include everyone. Maybe the Peter Lynch valuation isn't that suited for this right now, so maybe let's go ahead and exclude that one. This brings our average intrinsic value to $52, right around the current price right now actually. But obviously we also want to apply a margin of safety, and to do that we do have our margin of safety calculator over here on the right. We start with a standard of 25. Depending on some of the key metrics as seen earlier in the stock screener, we either add or deduct a little bit of margin of safety. In this case we do arrive at a margin of safety of 15. It adds a little bit for the payout ratio. I think maybe we could subtract that, but for sure we would definitely need just to adhere to the numbers right now just to see where it goes. As you can see here before, acceptable buy price of $52, margin of safety 15% gives us an acceptable buy price of around $45. But as we saw from the PE ratio and from the dividend yield theory graph, I think the current levels is a perfectly fine time to actually start a position if you're interested in Coca-Cola. I don't want to go into the details because everyone knows Coca-Cola and what they stand for and what a great company they are. Obviously also famously Warren Buffett owns a lot of shares in Coca-Cola. But let's jump back here and see the last couple of days here, last 5 days chart. You can see here, this was just based off that they anticipate a bad earnings report and it dropped almost 5%. Imagine what would happen if they actually delivered a bad earnings report. Then it could definitely come closer to this acceptable buy price target of around $45. So if you are interested in the company, I could imagine starting a small position now and then wait until the actual earnings report and see where that goes. Obviously, if Coca-Cola beats the numbers, then it won't go down. So I would leave it up to you. Thank you so much for watching, and I'll be seeing you in the next video.